Vicky, thank you. Yes, so my name is Samantha Oakley. I'm a commercial lawyer with Healy's. So that means I probably get more involved in the day-to-day running of businesses. And I'm joined today by my colleague Charlie, who's more of a corporate lawyer, and he can perhaps explain a bit more what that means.
Hi everyone, yeah, so I'm in the corporate team at Healy, so I mean we deal with transactions for companies, so very put simply, often buying and selling companies or setting companies up, dealing with what's called their constitutional documents, and we're going to talk a little bit about some of that today.
Brilliant, thanks. Did you, sorry, I was going to say, did you want me to quickly run through that bit? Yeah, so Charlie and I'll be talking about the business plans, shareholders agreements and directors loans agreements, and then we'll be handing over to Laurel, who will be talking about trading status, registering with HMRC, VAT and record keeping. Thanks, Vicky. Yeah, so first thing we're going to talk about today is business plans and why you actually need business plans. And one of the key reasons is actually because without a good solid business plan, you might struggle when it comes to funding an investment in loans, because anybody who is going to give you money either as funding or investment or as a loan, then frankly the first thing they're going to be doing is looking at your business plan, particularly in investments, because investors are always going to look for a return on their investment, i.e. they don't just want their money back, and they certainly don't want to lose it. They want to make money on their money. So they want to see that you've got a good solid plan in place, that you have plans for how you're actually going to not only sustain but grow your business. And that's kind of where the forecasting element comes in. I think it's something that's not really talked about as much, because we talk a lot about growth and scale, but we don't necessarily talk about the forecasting piece that goes with that, and actually how important it is for your forecasting to actually be accurate. And that's probably a good example of where legal and finance kind of cross over each other, because from a legal point of view, it's good to have these things in place, but actually at the end of the day, a lot of it comes down to numbers. So that's when it's good to have your accountant by your side as well, and you can talk to them and you can work with them and you can work through actually how you're realistically going to grow the business. And then the other thing is, having said a lot of it is about money, it's also about risk. So, you know, I'm sure we've all seen the episodes of things like Dragon's Den when they say, you know, have you actually protected that? Somebody's come up with this great idea. And the first thing they'll say is, well, actually, what have you done to actually protect that idea? Because if you haven't got your foundations in place, then again, it can be quite difficult to know how to grow your business. And indeed, in certain cases, they might say, well, have you actually thought about, say you're in the supplements business, because I know there's quite a lot of supplements ones that come up at the moment, you know, have you actually thought about your potential liabilities down the line? You know, what if you had a claim from consumers or something around the claims you're making around your supplement and health benefits and things like that. So when people are looking to fund, invest in your business by whichever method, things like that will actually form part of the bigger picture. And, you know, it's areas around risks and liabilities where we can help you, because we see a wide range of businesses all the time, and we can help you identify what those might be, and therefore then actually what systems, structures, processes, documents or whatever you can put in place to help mitigate those risks and liabilities, so that when somebody's actually coming to you, you've got all those answers there ready and all the solutions in place. And therefore, again, it helps, you know, hopefully helps increase your chances of getting that funding, investment or loan or whatever. And then in terms of, we've split our slides into, why and how, so how do they help? So I think one of the things when you're your own business is sometimes you actually forget about yourself and you forget that actually your business is there to help sustain you. And it's as important to have a business plan in place to help you understand how you can pay your own salary and your own dividends and make your business self-sustaining and supporting of you. And then the other piece to that as well is going back to identifying risks and liabilities. And like I was saying, one of the questions people might ask is, how do you actually protect this thing? Because if it's your way of doing something that's your USP, then, what's to stop somebody else copying that? So that's if part of what somebody is investing in is your USP, then it's actually quite crucial you can understand how to protect that. So that's why something like, your assets may be non-tangible as well as tangible. So that's why it's worth looking at around your IP and how you can protect your IP. And again, that's how we can help you understand what your intellectual property might be. And actually, again, what you might be able to put in place to help protect that, whether it's something like idea formation stage, and you've got to make sure you have your non-disclosure agreements in place, particularly if you're working up the supply chain, you've got to make sure there's as few leaks as possible in that, through to, protecting your trademarks. And again, if you have patentable inventions, how you might be able to patent those and things like that. So that's hopefully giving you a bit of a flavour as to why actually having a good business plan in place is really important and how it gives you good, strong foundations on how to grow. So, Charlie, you happy to take this one?
Absolutely, yeah. Thanks. Thank you very much, Sam. So shareholders agreements. I think what would be really useful to kick us off with is sort of a little bit of an explanation about what they actually are. So a shareholders agreement, put simply, is a contract between the owners of a business and often the company itself. And the purpose of that is to set out or govern the relationship between all of them and how the business will be run, how decisions will be made, and what should happen if something goes wrong or if you run into difficulties. It's separate from what's called your company's articles of association. And so your articles of association are the rules for the company, which are very important. It sets out procedure for decision making, and it's sort of governed by statute. And they're very important because they bind third parties. So if you're looking at, for instance, if you've grown your business and you're looking to exit, so if you're looking to sell, the articles of association will bind potential buyers of your company. But your shareholders agreement is different from this because it's between you guys as the business owners, and it's importantly a private contract, which means that you can sort of set out some bespoke terms or private arrangements which you wouldn't necessarily want made known to the public. Right, so that's a little bit of a background about what a shareholders agreement is. Why you need one? Well, it's kind of building on what Samantha has just said. When you're thinking about, especially at any time, we would say if you're starting up a new business, or if you've got a new business partner in, and there's going to be two or more owners of that business, it's very important to sort of set down and really be clear about what the relationship is going to be between you guys. So they can cover a wide range of issues because it's a private contract. They can kind of say whatever you want them to say, but some of the key things that they set out is, as we've written down here, are the expectations, roles and responsibilities of each party. So you might say that one person is responsible for this area of the business, one person is responsible for management of this of staff, or you can really say whatever you want. They also are are sort of a useful tool for setting out bespoke arrangements for dealing with how you will issue shares, how you will distribute profits. So you can have so that's obviously very important for you guys. because you want to know sort of your a practical way about getting money out of your business. And then what happens if you want to transfer your shares or get a new shareholder on board. So one of the sort of most important things about this is as it's a contract, it provides certainty. It provides you something to fall back on, and give you a roadmap if for dealing with certain situations. So a key thing here is sort of where there's a decision to be made, how do we make that decision? You can set that out and give yourself comfort that you know that you're covered in a shareholders agreement. They also are very important for dealing with disputes, and because it will give you, so for instance, if you've got two directors of a company, which quite often happens, you might have two owners of the business. In order to pass a decision at board level, you both need to agree, because a decision is passed at board level by passing an ordinary resolution. So what happens if one of you doesn't agree? Neither of you agree. What happens? How do you pass that decision? You can set that structure out within your shareholders agreement. So it's a very useful document. So, I mean, building and then continuing as what Samantha has said, how can they help? It kind of, I think the thing that we will be banging on about most as solicitors is contractual certainty. So it's everybody knows where they stand. It means that it's very clear that, and we'll kind of build upon this in the director's loan bit of the as well, but it's that what each party is bringing. So how much money you've invested, how much of a percentage of control do you have over your business, how decisions will be made, what happens if something goes wrong. And I think what we need to think about for a shareholders agreement is that they're a living, breathing document. So each time a change is made to your business, it's very important to then for you as owners. So if there's three business owners or two business owners and you get another owner on board, it's very important at that point to go back and have a look at your shareholders agreement and make sure the terms that you've set out previously work. And don't be afraid to update them, revise them, and it's always a good idea to get someone get some proper legal advice to make sure that you're not tying yourself up in knots, or you're not leaving yourself exposed in some way. I think so. When we talk about the last point here about it being like a prenuptial agreement, this is probably the most important thing of your shareholders agreement. So a well-drafted shareholders agreement will, as we've already said, provide contractual certainty and a framework for decision making, and it's very important for business owners not to get carried away. So when you start a new business, it's all very exciting, everything's very positive, people are willing to go the extra mile. But what can often happen, as with any human relationship, when things start going, when you've been together with someone for a certain period of time, the honeymoon period wears off, the gloss of the relationship wears off, and people can start grating on each other. So the shareholders agreement gives you something to fall back on if, for instance, the relationship breaks down between one of you and a business partner, someone isn't pulling their weight, or if someone frankly just does something wrong and they shouldn't do that. A shareholders agreement at that point will give you something to fall back on, and hopefully a way out. So then I think I'll pass back to you, Samantha, for this, and we'll jump in together here.
Yeah, so I think we were just going to, well, actually, just before we go on to director's loans, I think we're just going to give a couple of examples of things we've come across where there hasn't been a shareholder agreement in place, and actually, you know, where it would have been good to have one. So, for example, in relation to married couples or people in equivalent kind of relationships, then, you know, sometimes there can be an issue in that relationship if that splits, or indeed, there's been occasions where somebody is invested into a business that was already owned by a married couple, and then suddenly issues about decision making really became quite crucial and quite critical, and without the shareholders agreement it was very difficult to actually resolve that situation. And, you know, none too surprisingly, this person kept finding themselves on the wrong end of the couple always effectively outvoting them. So again, you know, in that situation, what you might have wanted to do is have weighting of votes, or say only one of the other party could vote, or there's ways around it. But you know, that's happened in the past. There's been situations where somebody might be putting cash in, somebody might be putting something in kind. So, you know, somebody might be putting the cash in, somebody might be putting all the intellectual property in. Say, for example, it was, you know, an existing platform business or something, and people were sort of saying, oh, well, let's get together, you know, there's synergy here. Again, suddenly there's disparity between people's expectations and valuations of what each person thinks their thing's worth. You know, somebody says, well, I've got evidence of this amount of cold hard cash and I don't think your thing's worth that much, whereas somebody's saying, but without this, the business doesn't work. So there's things like that of how to actually value different people's inputs. Particularly then when it comes to deciding on sharing of dividends and things like that, you know, what's a fair distribution. And another one I had as well is, again, it's quite common, you might have a creative person teaming up with more of a business-minded person, and the creative person go in that direction, the business person wants to go in that direction, because perhaps they maybe are slightly more money and numbers focused. And again, sometimes you can have issues there. So as Charlie was saying, you know, these are very, very common situations that come up, but they're best to be resolved at the beginning when the going's good, when you can have these kind of conversations, and then you can put some kind of a framework in place in writing, which, you know, can evolve over time. But yeah, so I think there's just a few common examples that might resonate with some of you as to actually why it's important to have a shareholders agreement.
Yeah, I think just building on that finally is that one situation that we saw recently was where you might have a majority shareholder, so there is a key holder of shares who holds the most of the percentage of the business, and they were looking to sell their business, but they had what's called a minority shareholder, so someone with a smaller percentage shareholding. And they were presenting issues and difficulties for the for the majority shareholder to actually get the sale over the line with the buyer. So one of the key things a shareholders agreement can provide is protection for both your majority shareholder, to make sure that if they want to sell and there's a key they hit that threshold for decision making, then they can what's called drag a shareholder along, another minority shareholder along with them, and effectively force them into a sale if they want to sell, because they're the majority owner of that company. And then likewise, you've got, you can see it on the flip side, what if you're a smaller shareholder who is potentially, you know, would be scuppered if they were left in that business once the majority shareholder leaves. You can provide protections for a minority shareholder to make sure that decisions aren't made unfairly, and if a shareholder is going to, if there's going to be an exit, then you can participate in that too. So they call that, on the converse of dragging along a shareholder, you can tag along with the majority shareholders. So yeah, this is just another example we've seen recently of where having that in, or not having that in place, created a lot of issues. And if they had those arrangements and they thought about that at the time, then they would save themselves a lot of issues.
Yeah, and also investors as well, like the drag along, tag along, because again, you might say, I'm only prepared to give up a certain amount of my business, because depending on how much they're prepared to put in, but actually they might want that kind of a right, because as I was saying right at the very beginning, they want that return on their investment, and you know, they're savvy enough to know that there's all these mechanisms in place that might help them. So yeah, it all comes, this is where it comes slightly circular back to, you know, make sure you've got a good business plan in place to justify having somebody at maybe a slightly lower shareholding.
You might notice there might be a bit of a theme to everything that we say.
Brilliant. Do you want me to do directors' loans?
Yes, I think we'll sort of jump in. I'll jump in as and when you'd like.
Yeah, so as we're talking about at the beginning, there are a few ways to get money into a business. Funding is one of them, investment's another one, but loans are another one. And as well as getting outside loan investment, then you yourself as a director can put your own money into the business. And commonly, if you're a single owner shareholder business, so it's your baby, I think it's quite common that you, as a director owner, might end up putting a lot of your personal money in, either as seed funding to get it started, or, you know, we all have those cash flow moments where sometimes you just need to actually put your own personal money into the business just to pay some bills and things like that. So it's very easily done. I say this from personal experience. It's very easily done to just hit those crunch points and just put your own money into the business. But what happens if you haven't actually evidenced that? And there's two problems here. One is trying to prove whether it was actually a loan or an investment, because without any clarity as to the fact that it was meant to be a loan, and there are terms around what the loan are, and it's clearly stated to be a loan, then actually it could be deemed to be an investment. And as we've all heard a million times before, you know, the value of your investment can go up and go down, because investment means risk, you don't automatically get it back. Whereas with a loan, that's the whole point. You're saying, I'm lending money with every intention of getting it back, and these are the terms on which I'll get it back. So that's the first important reason to actually have a director's loan agreement in place, is to show that actually it very much is a loan and not an investment. And then again, if you want to secure the loan, so if you're thinking, right, okay, you know, I'm lending you this money, but I know you've got enough assets in the business, either tangible or non-tangible, because again, you know, with a loan, the intention is you're getting your money back. So if there's not enough cash in the business, you might want to secure it against assets in the business or something else. So again, if that's your intention, you have to make that perfectly clear, because if you don't, then the assumption will be you weren't intending to do that, and therefore again, you know, your loan could be at risk, particularly if in the unfortunate event the company then goes into some form of liquidation. You know, your ranking will suddenly slip very far down the ladder. So yeah, it's definitely worth, as I say, I know in the heat of a moment it's easy to forget, but as much as you can, please do try to remember to actually evidence that you've put money in as a loan and not an investment.
I think, yeah, it's very important to do that. So especially, Samantha, you said from your own, a business owner side, what I maybe build upon that as well is if one way that you'll be looking to raise funds will, if it's not going to be through giving away equity or shares in your business, will be getting a loan in. So you might often get a loan from a third party, so maybe friends and family, or you know, another investor that's going to come in, see some potential in your business, and you don't want to give away shares, so you'll ask for a loan, or they'll want more security over their loan. What's very, very important is again really the same point as Samantha has said, is not to get carried away. And I think, and it's very difficult, I appreciate, when especially with a startup, there's so many jobs going on, there's no money to do anything, but to make sure that you document properly the terms of that loan, because there is nothing worse. So if you get a startup baby company that suddenly grows into something fantastic, and then you've got someone that gave you your startup loan who then starts alleging that they are now shareholders in your business, and you get yourself into all sorts of hot water about having to unwind or decide how that's dealt with. Equally, if it's the other way around, like if it's a third party, your friends and family can sometimes the relationship between them can be utterly ruined by money and how that is dealt with. If you had considered that this was a loan that was to be repaid over a set period of time with a set amount of interest, with protections in place for the lender, if something went wrong, or if you did something with the business that they didn't like, then it's very important to get that set out in writing at the beginning. And also purely from, so as well, sort of building on what Samantha has said, one of the things that, and this is very boring from your point of view, but very important from our point of view, is to make sure that there is an appropriate company paper trail of the decision that has been made to enter into the loan. So that maybe Laurel will talk a bit about how important this kind of thing is a bit later on. But when it comes to accounting or to HMRC, it's very important that there's documented evidence that a loan was made to this company at this time, and that the company approved the terms of that loan. So you need to hold your board minute, you need to write that down, you need to show that it was the right steps were taken to make sure you're not in breach of any laws, which is very easily done, and we've seen it time and time again. The good thing with that is that it's not fatal. If you're thinking now, oh dear, I've done that. If you need to document that, it's something that we can do after the event. It's called a ratification, and it's a relatively simple process. So fear not if that's something you're sort of panicking about now.
And actually, the other thing I would say as well is going back to sort of what we're talking about in the shareholders agreement side, but going back to exit sale of the business. You know, there have been situations where directors have put their own money in, an investor or a buyer has come in, looked at cash flow, looked at the books and thought, oh, these look healthy, they offer a price on that basis. And then suddenly the seller was saying, oh yeah, but by the way, actually half that money's mine and I want it back. And that has caused huge issues as well. You know, one, because of the valuation, and then two, if without these directors' loans agreements in place, how do you actually prove that you're entitled to that money back? You know, you might have been holding the money in the business, hoping to get a buyer and hoping to get your money out at that point, but without anything to actually evidence that, then again, it's very difficult to justify why you want your money back out. So yeah, I think, and the other thing actually, just quickly on, it's not strictly on directors' loans, but just quickly on loans in general. There is something called a statutory demand, which is a company wind-up notice. So going back to Charlie's point of if you get loans from people and they end up not happy because the terms weren't documented and they're expecting their money back and they haven't got it, they can apply for something called a statutory demand and actually try to get your company wound up. So again, that's another good reason to have these things documented. Sorry about that, Vicky, I just threw that in at the last minute.
Okay, so this is the point where I take over. I'm Laurel Giles and I work for Plus Accounting. I'm a manager in the business services department. So we look after a lot of companies and directors of those companies as well. So I'm once going to start by talking about the different structures of business that there are. So you've got this great business idea, it's going to take off. But you want to spend some time at the beginning just thinking about how it's best to set that up, because how you set it up in the first place is going to have impacts on things like how you take money out of the business, investors, how you're going to raise funds, that kind of thing. And it's also about tax and tax efficiency. So the main business structures are, as they are outlined on the slide, is sole trader. So that's if you are just by yourself and you have this business idea and you just want to go ahead and be self-employed, that's fine. You don't have to incorporate as a company. What the differences are is the tax side of it. So it depends partly if you've got any other income. So if you've got either employment income and this is just a sideline, or you've got rental income, that's all going to impact on the tax that the sole trade profit is going to be taxed on. And the different levels of sole trade taxes you get, initially you get a personal allowance, which is a bit that you can earn without paying any tax on, which for this year is 12,570. And then after that, your sole trade profit will be in the basic rate, taxed at 20%. And then once the income is profits are over 150,000, it goes into the between 37,000 and 150,000, it gets taxed at the higher rate, which is 40%, and then after that it's 45%. So it's taxed the same way as employment income is. On top of tax, you'd also have to consider that you would pay Class 2 national insurance and Class 4 national insurance. Class 2 is a set £3, 5p per week, and class 4 is on 9% of profits between £9,568 to £50,270, and then 2% on profits thereafter. So it's a lot of numbers and figures when you're thinking about trading status. So that's very, very whistle-stop tour of self-employed. Partnership is if you've got more than one individual and they want to come together and join up forces. So you've got, like Sam was saying, you've got a creative person and you've got a finance person. They might think, oh, well, let's come together and be a partnership. That's very similar to sole traders. The partnership itself doesn't have any tax to pay, but the partnership reports its profits on a tax return, and it splits the profits between the partners when they've got a partnership agreement in place, and it's the individual partners who are taxed on the profit on their self-assessment forms. Limited liability partnership is similar again to a partnership, but it has the benefit of having limited liability. So the partners are only liable for the money that they put in, and not the partnership is a separate entity, so it's got its own debts and its own money, and so your personal assets are protected to an extent. Then you've got a private limited company, which can be limited by shares or by guarantee. So that's when you incorporate at Companies House, and corporations pay corporation tax, which is at the moment a flat rate of 19% on any profit that is made. So if you just make £1 of profit, you pay 19%. You don't get that personal allowance that you do if you were a sole trader. So there are other benefits of possibly thinking about incorporating over sole trader. So one, there's the tax benefit. The flat rate of 19%, if you've got high profits, is going to be better potentially than being taxed at the 20%, 40%, 45% bands. You've got the limited liability protection. So again, you are protected against the company's debts. The company is separate from yourself, and it's the company that makes the profit and has the money. There is flexibility from having a limited company structure, because you can determine, so the company makes the profits and is taxed on those profits, but then you determine how you take that profit out. So you can have a salary, which is then taxed on you as on your self-assessment. You can have dividends, which is taxed on your self-assessment, and that split can be set up to be tax efficient as possible. So there, yeah. And also the other thing about being a private limited company is it can give you an element of credibility. So if you're looking to raise funds or raise investments, people might take more kindly to a limited company because they don't know from the outset how big that company is. They don't know it's just you. Could be like loads of people. So it's like a facade kind of thing. So that could be good. And also if you're looking for customers or suppliers, they might also treat you more favourably if you're a limited company, because you've got that credibility. And the difference between being limited by shares and being limited by guarantee, you might consider that from an investment point of view. So if you're limited by shares, you've got equity, and to raise investment you can give some of that equity away in return for finance. So that might be one way that you're thinking of raising money. If you're limited by guarantee, you don't have shareholders or shares, you have guarantors. So it means you can't pay dividends, you can't give out equity of your business. Some companies want to go limited by guarantee if they are social enterprises. They think it looks better that you're doing a business for the benefit of the community, and therefore you're going to use the profit that the company makes to keep it in the business and fund the business, and not just give out it as dividends to the owners. So that's why you might want to think about that structure. And the last one is being a community interest company. So this is again a social enterprise side of things. There is a lot more compliance to being a community interest company. So not only would you have the same compliance as a limited company, so you'd have your accounts and your tax return, but there's also other forms about how you've benefited the community, how you've involved your stakeholders in the business, and that kind of thing. And that is, yeah, that's important to consider. Yeah, then the final thing about being a community interest company is that you've got this thing called an asset lock. So it's difficult to get assets out of the business. You can only transfer them to other CIC companies or other charities, to the idea being that you don't get the benefit of those assets personally, it's for the community. So yeah, that's a very whistle-stop tour of all the different structures of a business. And as I said, like the choice that you make is going to depend on, to an extent, your level of profits that you're thinking of making. If you're estimating to make a really high profit, you might want to consider being incorporated rather than a sole trader, just because of the tax brackets. Similarly, if you've got a lot of other sources of personal income, you might want to incorporate. Again, that's tax reasons. As I said, raising finance. If you've got a limited company that's limited by shares, one way to raise finance is to give out the equity in your company to investors who then want a return on the investment. Whereas if you were limited by guarantee, you might find that method of raising finance is going to be trickier. So you're more limited to like loans, for example. Profit extraction. So sole traders don't have that issue. What they make is what they keep in the tax year. But limited companies, as the limited company is separate to yourself, you can take out money as a shareholder in terms of the salary and the dividends. Level of compliance is something to consider. So a sole trader and a partnership, partnership will have a partnership tax return, and the individual partners will have their self-assessment tax returns. Sole trader will just have a self-assessment tax return every year. Limited companies have more compliance because they will have to file annual accounts to Companies House. They'll have to file a confirmation statement to Companies House every year, which is just detailing the shareholders and the directors of the company. And they'll have to supply a corporation tax return and another set of company accounts to HMRC. So that's three different things that they'll have to do. And as I said, the CIC has even more than that because it has extra forms to complete and submit to the CIC regulator. And that level of compliance brings in a different level of fees. So your accountancy fees or professional fees, if you're a sole trader, are going to be lower than if you're a company because of the extra stuff that you have to do as a company. And as I said, the perception of others, it might be better for you, depending on what your business is, if you were limited, because you might get more customers out of it than if you're a sole trader, for example. Oh, that's a lot of talking. So once you're set up, you need to think about registering for taxes. And the taxes that you need to register for are the income tax, the national insurance, that's your self-assessment to HMRC. If you are incorporated, you will need to register for corporation tax with HMRC. If you want to bring on people and pay them a salary, then you want to register for PAYE. And if your turnover hits certain thresholds, you might need to consider VAT registration as well. VAT, you don't have to register just because your turnover gets to the threshold. You can choose to register voluntarily, but I'll talk about that I'll talk about VAT registration in more detail a bit later. Okay, so sole trader. So you need to register with HMRC for self-assessment and national insurance within 3 months of the date that you start to trade. Most commonly, you could do it through HMRC's website, and at the same time, it will create your portal with HMRC. So HMRC will send you out a 10-digit unique taxpayer reference through the post, and that is, you need to hold on to that because that is the number that you're going to need to be able to submit your returns. It identifies you to HMRC. So if you ever phone HMRC or write to HMRC, that is your reference number. So then you'll receive another letter through the post with the activation for your online portal, and that will have a code. And then is the portal, as I say, it's the portal you can log into and see your tax overviews and how much tax you have to pay, and submit your self-assessment through that portal. So the self-assessment tax return itself is due by the 31st of January after the tax year. So for last year, 2021 tax year, the return needs to be submitted by the 31st of January 2022. And any tax and national insurance contributions are payable on the 31st of January. And another thing to consider actually with a sole trader is if the tax that you pay or are due to pay is over £1,000, you also have to make payments on account towards tax for the next year, which for the first year that happens, it can be a bit of a shock because it's suddenly quite a big outlay, but then you fall into that pattern and you're always paying in advance going forwards. And payments on account are due by the 31st of January and the 31st of July. Okay, so partnerships. You have a nominated partner in your partnership, and that just means that you've designated somebody to be responsible for submitting the partnership tax return to HMRC, and the other partners register separately as partners. You have to register by the 5th of October in your business's second tax year. So if you started a partnership or became a partner during the 2021 tax year, you've got to register before the 5th of October 2021. That would be in your second year. And again, you can register through HMRC's website, or you can register by post. The partnership will have its own separate unique taxpayer reference number, and the partnership needs to submit a tax return. Again, it's due on the 31st of January after the tax year, same as for sole traders. But the partnership itself does not pay tax. The partnership will split the profits according to the partnership agreement, and the tax will be payable by each partner individually on their tax returns. Limited liability is similar. Limited liability partnership is similar. So when an LLP is incorporated at Companies House, HMRC will automatically be notified. So you don't have to register separately with HMRC, it's automatic. And yeah, you don't have to register for corporation tax. You have to, again, you split the profits, and it's the individuals that record their profit and pay it on self-assessment. Private limited companies and CIC companies, again, once you incorporate at Companies House, HMRC automatically get notified. So HMRC will issue a 10-digit UTR number through the post to the company to the registered office address within 14 days of incorporation. And again, it's very important that you keep hold of that UTR number, because that is the company reference. It's what will be on all of HMRC's correspondence to you. And then once the company is registered, it needs to submit a corporation tax return to HMRC every year, even if the company has made losses, with the exception if you incorporate a company but you're not using it and it's dormant. So the only transaction is the £1 share, for example. Then you don't have to submit a corporation tax return or pay tax until the company becomes a trading company. So after you've done all that registration, you might think, oh, I grow my business, I need to employ somebody. So to do that, you're going to need to register for PAYE. So you need to register for PAYE even if you're the only director and it's just you taking a salary. You have to, for it to be recorded in your business as a salary rather than just as drawings, it needs to be going through a PAYE scheme properly and being recorded as salary. So you must register with HMRC for PAYE before the first payday, and you can't register more than 2 months before you start paying people. You can do it online for registration, or you can do it by phoning HMRC. there's been quite a few cases at the moment that I've had where you've got an overseas business owner and they haven't been able to get a UK national insurance number. And one of the things you need to register for PAYE online is a national insurance number. So the only way around that is to register by phoning HMRC. And other business structures may need to register in other ways. If you go onto HMRC's website, it will have this flow chart and it will say, are you trading as blah, blah, blah. And then you click through it and it will tell you how to register if you can't do it online. Once the company is registered, HMRC will issue the company with a PAYE reference number, and you'll need a PAYE reference number if you're going to be doing things like making use of the government's Kickstarter scheme, for example. And also the other thing to think about when registering for PAYE is that you might have auto-enrolment registration obligations. That's to do with pensions and paying your staff pensions, and you've got to also make sure that you're paying them minimum wage, and there's a lot of other legalities around being PAYE registered. The last one for tax registration is VAT. So at the moment, the compulsory VAT registration threshold is £85,000. So if the business is going to exceed that threshold, it's got to register for VAT. And there's two ways it can exceed it. It's either over a rolling 12-month period. So that's not from your accounting period necessarily. So if your accounting period was January to December, you've got to look at your turnover for that period, but then it goes from March to January and so on. You can't just say, oh, from January to December it didn't go over, so I'm okay. You've got to keep an eye on it, especially if you're at the cusp of being at that threshold. The other thing is, if you expect that your taxable turnover is going to exceed 85,000 in the next 30 days but alone, then you have to think about registering as well. So once your taxable turnover reaches £85,000 over a 12-month period, you then have 30 days to register for VAT once it goes over that. So if it went over it in December, say you've got by the end of January, you'd have to be registered. And if you expect it to be in the next 30 days, you've got to register a bit sooner. For example, if on the 1st of May you realise that you're going to exceed 85,000 in the next 30 days, you've got to register by the 30th of that month. And when you are registered, HMRC will send you a VAT certificate and it will tell you the date, your effective date of VAT. And from that date, you must charge VAT on your sales at the appropriate VAT rate. And you will need to start to complete online VAT returns, which are usually due quarterly. So you can change your VAT. You can choose which quarter your VAT returns fall on, so you can tie it up with your company year end. So if your company year end is March, if you then you can have a VAT quarter finishing in March as well. It's neater. If you had a VAT taxable turnover below £85,000, you can also register for VAT. That's voluntarily registering. You might consider doing that if you've got a lot of purchases at the beginning and you're not making a lot of sales, or your sales are 0 rated. So say, for example, you are delivering fish, for example, that's 0 rated supply, but you've got purchases that have VAT on them, so you're going to be getting VAT refunds each quarter, so you might consider voluntarily registering. So that'd be a good thing to do. There are other schemes, so as well as just, so you've got the standard VAT scheme where you charge VAT on your sales, you reclaim VAT on your expenses, and you pay HMRC the difference. That's the standard scheme. But there are other schemes such as the flat rate scheme, where you would pay a lower percentage to HMRC based on your gross sales, but you don't recover any VAT on your purchases. So that would benefit businesses like mechanics, because their flat rate is only something like 8%. So you pay over 8% on your gross sales, you don't reclaim any VAT on your purchases, but that difference that you pocket, that the business keeps, is subject to corporation tax. So that's just worth knowing. And then from the 1st of April 2019, HMRC's Making Tax Digital came into play, which requires businesses to file your VAT returns digitally using compatible software if you are compulsorily having to be VAT registered. So this is going to affect what I'm going to talk about in a minute, which is your choice of bookkeeping. So yeah, how you do your bookkeeping. So you might consider using a bookkeeping package that is something like Xero, or something that's compatible with HMRC's Making Tax Digital platform. Because Excel is compatible, but you've got to get bridging software to make it happen. And from the 1st of April 2022, HMRC will require all businesses to file VAT digitally using their MTD digitally compatible software. And from this April 2021, they've already started introducing it by saying that all VAT registered business have to submit their VAT returns using digital links. So they're starting to bring it in, ready for the 1st of April 2022. Okay, so record keeping is the other thing. So there are legal requirements, and you just need to know what to keep. So your business records, you need to keep them for the current year and the previous 6 years. And they can be kept as hard copies or as soft copies, provided that they are legible and accessible. So you need to be careful where you store them so they don't get corrupted if you're storing the digital copies. And your business records will not only be your financial records, but there'll be things like your dividend vouchers and your meeting minutes. There'll be your business plans, budgets, forecasts, directors, shareholders agreements, all your correspondence. Everything that relates to your business is your business records. And as Sam and Charlie were saying, it's important to keep them just in case things go wrong. You've got that paper trail, you've got that audit trail, and you know where you stand, basically. Okay, so when it comes to financial record keeping, the answer is yes. 6-year rule applies to all business, even sole traders. So financial record keeping, the basics is choose a tool that will work for you. There's no point in making it overly complicated because you need to be able to use it basically at the end of the day, unless you're hiring a bookkeeper. So you can use Excel, that's perfectly fine, or you can choose to use a cloud-based system like Xero, Sage Online, QuickBooks Online, Zoho Books. There's numerous different options available. Most of them are on a subscription basis. Some you can get free. I think it's NatWest. If you opened a business bank account at NatWest, you get a free agent for free. So you just go ahead and use that one. We at Plus Accounting champion Xero. We've got a Plus advisory department here who are all about Xero and help businesses set up and deliver training on that platform. And there's the traditional desktop packages like Sage. There's also QuickBooks also has a desktop version. The benefit of the cloud-based ones is, especially if you're using an advisor, is the access. So it's in the cloud. You can invite your accountant to be a user, and they can log in, and you can just say, oh, I'm having difficulty with this, and can you log in and just see what I'm doing? And it's easier to do that if you're in a cloud-based system, and you get the more up-to-date view rather than something like Excel where we'd only see it once a year and we'd be commenting on it after it's happened, and it could be quite a long time ago. So the choice that you make will be influenced also by whether you need to submit VAT returns, for example. Is going to be easier to do that with HMRC's Making Tax Digital if you're going to use a cloud-based system like Xero. But yeah, choose one that works for you is the best thing. So the benefits of having well-maintained accounting records are you get a quicker conversion of accounts receivable into cash. That means when you raise an invoice to a customer, you can track it. So you can see on a system like Xero or QuickBooks if you've been paid for that invoice yet. You can chase it if it hasn't been paid. It's really easy to see. You get better tracking of expenses. So again, you can, in Xero, you can have a profit and loss report that will show you're spending X amount on travel, X amount on subcontractors, X amount on wages, and you can track it and you can investigate any unexpected blips, right, on it. So it gives you better cash management. You get real-time access to your bank balances. So Xero again has a bank feed, so you don't have to manually type in all your bank transactions. It automatically uploads them straight from the bank, and you just reconcile it. And you just need to you do need to manually check it at the end of the month, so that the statement balance and the balance on the system matches. You get the ability to plan ahead. So because you can see what expenses you've got and what income you've got, you could take a rough guess and say, well, this is actually how much tax is looking likely to be due, because you know that corporation tax is 19% on the profit. And then once you take off the tax, you know what profit you've got, and therefore what capacity for dividends you have to pay out, because dividends are distributions of profit. They're not company expenses. So that's something to understand as well. You get increased understanding of your business finances, so you can see if you've got a circular business model really clearly, and you've got your customer and supplier records and contact details readily available. You don't have to search through things to find those. And it can give you better customer and supplier relationships, because again, you can see if you haven't paid a bill, you can see when it's due, plan to make the payments, that kind of thing. And because it's all nice and neat and tidy, it takes less time to produce accounts and tax, and therefore should be slightly less as well. So that's always good. So that comes to the end of my section, and I hope I answered any questions that anybody had. If not, feel free to ask.
Thank you very much, Laurel, Charlie and Samantha. I think that was really good, and a whistle-stop tour of everything you need to think about when setting up a company. A lot, basically, I think, is the summary. I didn't know if after that was anything you wanted to add, Samantha or Charlie, that kind of sprung to mind, or if you were happy with what's been said. I think there were a few questions, but I think that they've probably all been answered throughout both discussions.
I think what I would say, like you say, that because there is a lot to think about, then we are here to help. So yeah.
Okay, well, if there's nothing else from the attendees, I think we'll wrap up. I think that was I think we stuck to an hour perfectly there, so that was very good. Well done, everybody. So thank you to those that joined us. We're obviously recorded the session, so we will send that round to everybody, and if from that there's any questions that arise, please feel free to get in touch with Charlie, Samantha from Healy's, or Laurel at Plus Accounting. Okay, thank you very much, everybody.
Great. Thank you.
Thanks, guys.